Good morning, everybody. Welcome to the Flow Show. Here we are again, ready to do better with the markets. Morning, K-Man. How are you doing today?
Morning, Ryan. Morning, everybody.
You all good?
Oh, yeah. Fine.
Tickety boo.
It's ranging. It's ranging.
Cool. Right. Let's get stuck right into it. Quite a bit of data out today, so we'll get through all that shortly. Going to start off with the PBOC in China and a piece from the Securities Times from a research mob. Hutai Securities said the PBOC should cut the RRR to stabilise year-end liquidity. It makes the point that in order to ensure a good start for credit in the first quarter of next year, banks usually gradually reduce their credit extensions in the fourth quarter. But due to PBOC requirements to keep lending, they believe that credit may still need to increase at the end of the year rather than reduce, which they say will increase the pressure on banks' liquidity and capital assessment indicators, thereby further reducing banks' willingness to lend funds. He suggests that an RRR cut would be required to loosen up the liquidity to allow them to keep lending into the end of the year. So that's potentially something to keep an eye on. We may get an RRR cut coming in the latter part of the year, which will keep China on the easing path. Meanwhile, there were fresh reports that China's major state-owned banks were again acquiring dollars via onshore swaps and then selling them in the spot market today. So again, they're still keeping a bit of pressure on dollar yuan by those dollar sales to keep it, as I say, on the right side of the track that they want it on for the moment, and that's a weaker dollar yuan or stronger yuan. Moody's got their cage rattled as well. They affirmed China's A1 rating but changed their outlook to negative from stable, which, as you can imagine, didn't bring that much of a favourable response out of China. But what's done is done. Moving over to Japan, we had the Tokyo CPI out. Might as well go through the data now while we're here. So that Tokyo CPI coming in softer than expected. If I can find it, where's it gone? There we are, up the top. So headline CPI coming in at 2.3% versus 2.4% expected, as you can see, lower than last month as well. Then we had, well, that's the core, one of the core numbers. Headline CPI coming in at 2.6%. One of the other core number, which is ex fresh food and energy, came in at 3.6%, lower than the 3.7% expected, and 3.8% previously. They don't show all the numbers on this calendar. So Ueda is getting his wish fulfilled at the moment, with inflation coming down into the latter part of the year. Not that there was too much reaction, I don't think, Kay, on this data overall, but dollar yen is looking a bit more perkier today.
No, it didn't react much, right? It was all quite well expected. Yeah, I mean, yeah.
Market eye isn't really on this at the moment, it seems.
Sorry?
The market's eye isn't really on this data for now, it seems. I think it's sort of brushing the BOJ under the rug until the new year.
Yeah, I think so. We've got to put it on hold. We had also a 10-year JGB auction overnight, which did okay, if I read that correctly. So yes, it looks as if the market is just trying to look for a possible future direction, but it does feel very much like it's going to depend on the US numbers more than on the Japanese numbers right now. Yeah, CPI is coming down, Ueda is correct. Yet the yen is not really, dollar yen looks to hold this 147.30, 65 zone that we identified earlier. Had a little sniff down, but then it came back up. It's trying to hold that level, and I guess we are going to depend on the US data now to see if it holds. On the cross side of things, though, yen is not giving up too much, although also the yen crosses are also bouncing a bit. So I really think it's going to be up to the data elsewhere to depend. That's going to drive the yen for now. But if it only depends on Japanese CPI and Japanese data, there is perhaps a case that the yen strength has ran its course just right now. But again, it's a fluid situation in my opinion. I still can't really figure out whether we have to do anything in yen right here and now. Quite volatile, I must say. If you look at euro yen, it's got more than 100 points range so far, but yeah, for me it's difficult to find a clear direction right now in the yen. Tempting to buy yen because it's strengthening, but then we know how the reaction can be. Imagine that we have relatively decent numbers out of the US, and all of a sudden your dollar yen can be back at 148, and all the yen crosses a big figure higher as well.
Yeah, exactly. I think that I said the Bank of Japan is sort of, for the market, is on the back burner. When you've got the market trying to guess when we're going to get 25 pip rate cuts, whether it's March, June, July for the Fed, ECB and all the others, whether they're going to cut 100 pips in 2024 or 150 pips in 2024, that's all going to overshadow whether the Bank of Japan stop doing negative rates and then move 0.1% or 10 basis points of rates from minus 0.1 to 0. So they're on the back burner. They've set their stall out. We know about the wage rises. We keep an eye on inflation, but I think for the BOJ meeting on the 19th, it's going to pass by pretty much without any fuss or bother. But we can talk about that nearer the time. I haven't scratched my itch just yet, Bran. I'm still itching. I'm going to try and long it out. Hopefully the prices go my way. Right, moving on. We might as well crack through all the rest of the data, seeing as we've got the calendar up. So we've had it's Services Day going on now. We've had Australia coming in. Again, a miss there. They had a bit of a miss on their manufacturing as well. So worse than expected on that number there, further into contraction. Japan as well, they moved backwards, was expected to go up a pip, and they went down a whole chunk to 50.8. So again, we're now seeing a bit of weakness coming into the service sector in a few countries. Not so in China. They moved up to 51.5 from 50.4 previously, beating expectations as well. Then coming into the Eurozone, we had some industrial production numbers out today, all pretty much with negative numbers on them, particularly from Spain and France, as you can see there. Then we services PMI Spain. It was all right. It was expected to rise to 51.5. It came in a pip softer than last month. It's still in expansion, so no harm, no foul there. Italy saw a little bit of a boost, 49.5. So now creeping closer to that expansion number. It was pretty much a similar theme as we saw in manufacturing. France as well, just a little bit better than expected, 45.4. Germany, also another one creeping back towards the expansion line, 49.6, which is a big improvement over the flash number, 48.7. UK as well. Well, there's the pan Eurozone number, reflecting what we've seen in the others. UK as well, better on the final reading than the flash. The flash was 50.5, 50.9 was the final number, so a decent bounce there. PPI in the Eurozone coming in up on the month as expected, 0.2, and there or thereabouts on the year, down 9.4%, a little less than the 9.5% there. So data overall, similar themes. A lot of economies still in contraction, but seeing some tepid improvements, shall we say, while others are getting their noses into the expansion line. We had, let's go back to Japan quickly, because Asahi noted that Japan might be issuing a limited extension to some of its home loan tax breaks. So a bit of further fiscal easing there. Gigi Press also had a piece out on the BOJ. It says that the BOJ sees monetary easing as having pushed up prices by 1%. That's what all that easing gets you, folks. 1% rise in prices. Some might think it's not worth a cost, but you try telling those guys that. Over in the UK, more surveys out on inflation. This is the City YouGov poll showing that 1 year, 12-month inflation expectations fell to 4.2% from 4.4% in the prior month of August. So a 2 pip drop there, but 5 to 10 year inflation rose 2 pips to 3.5% from 3.3% prior. Kantar had their latest retail price metrics out, grocery prices, or grocery inflation. That slowed again in November. Though they say while the rise in the cost of traditional Christmas dinner is tracking well below the headline rate. And that's what their data showed. So a little bit of slowing in grocery inflation. On the rate cut expectation front, UK swap rates, interest rate swap rates have apparently brought forward expectations for a first BOE rate cut. We're almost fully priced in for June. Mark in our chat room pointed out via the Sonia pricing that we're sort of pricing 33 pips between June and December, so a bit more than a full point cut there, depending on how you want to read those numbers. And it's a general theme we're seeing today. The market now bringing forward all these rate cut expectations. Over in the ECB, ECB Centeno has warned that Europe's jobs market can go awry pretty quickly. So a bit of a warning there. Then we had ECB Schnabel, which the market has jumped up and down about, apparently seemingly turning far more dovish. It's pretty much ruled out another hike, basically after the November inflation data, and said it was remarkable how fast inflation had fallen in that data. It caught her particularly off guard in the steepness of the fall. Rest of the comments were pretty much as she. I looked at the speech and I compared it to a speech of last, I think, 21st of November, and the rest of it was all pretty much the same comments. Still expects it's going to take a while for inflation to come down to target, and all the rest of it pretty much unchanged. But the market, it's quick to jump on anything that sounds dovish, whether it's really dovish or remotely dovish. But yeah, she's been caught by surprise just as much as she was caught by surprise along with all the others when inflation started rising. So no real surprise there. Okay, gave the market a little bit of a shake around, but it seems the data has turned that around as well.
Yeah, also the timing of the day. Came in like at the end of the Asia, just before the EU Open, sorry, the European Open. Yeah, it's just one of, okay, the rest was the same, but she does change a little bit. So she just joins the camp of saying like, okay, we're done here. Yeah, I reckon the market reaction was to be as expected because it was one of the milder hawks that is changing her view as well. Does look like there's a bit of interest there around this 108 in the euro dollar. I thought we could actually push through a little bit this morning, but it stabilizes again within yesterday's range. Yeah, just one more joining the camp of the we are done, and we were joking about it in the room this morning. Nagel, Holtzman, Kazakh, if they start to change, then probably the euro will get hit. especially Holtzman, who is still an Uberhawk. That could bring euro or more pressure on the euro yields. Yeah, and for the rest, it's roughly the same as in all the major central banks. If you take the RBA decision overnight, was about the same, right? Coming from a relatively more hawkish stance that Bullock was still trying to defend earlier, also changing now more to neutral. And it's the same as in all the central banks, right? We'll have to see what front running the events a little bit. We'll have to see what Jordan SMB says next week. He could be a big mover for the Swiss franc, but for the rest, yeah, they're all on the same line, barring the Bank of Japan, where we still have to see the start of the beginning.
Yeah, exactly. I nearly forgot the RBA as well. Yet they held rates unchanged, as was widely expected, and their statement also, as expected, moved to a more neutral tone. I read the statement on that as well, and they were quite hawkish in the last one where they hiked. This one was back to we're data dependent. Things are going our way. Happy to sit on our hands and watch the data. So yeah, very neutral statement. And I'm expecting a similar from the BOC tomorrow as well on that front.
Mm-hmm.
ECB also had a survey on inflation out, but nothing to rip up any trees there. Expectations were unchanged for the 12-month outlook and the 3-year ahead outlook. Germany's IFO is not expecting any major boost from Christmas sales to German retailers. So there's a lot of talk going around about retails not living up to expectations for the Christmas period, holiday period. We won't know much about that until we get some of the retail sales data either later this month or early in the new year. On the rate expectation front there, Eurozone money markets are now pricing an 84% chance of a 25 BP cut in March. So as you can see, it's bringing forward all these rate cut expectations, and Schnabel was a lot behind that. Those expectations were 72% on Monday. So it's all part and parcel of the market just moving its chess pieces around as speakers come out, as data comes out. And we will follow those, obviously. I'm wondering if perhaps in the euro, just quickly, we've had this hold down at 108. It's I'm wondering then a lot of pricing being soaked up now. We saw it with the Fed. The market selling dollars. We saw yields coming off. In the last week or so, the ECB are getting it in the neck as the market changes its forecasts. I'm just wondering, perhaps this hold of 108 is a sign, Kay, that maybe for now the market's happy with where it's at. It's had its little sell-off, and now we're sitting back and waiting for which way the pendulum swings next, if you like.
Yeah, I think you're right there. Well, I did resell just a small bit, but I've been gradually scaling down my sales from last week into this move here. Now it's all going to depend on US data again, I reckon, because the market is so fast in swinging around. We're hanging around those levels in the US data as well. Get weakness. We probably have seen the bottom in the euro dollar for a while, despite whatever the market may expect on the ECB rates. Because let's face it, it's just like a lot of it is just like pendulum swinging. Yes, we are expecting those things, but then if you start to price in nearly 1.5 rate cut in the spring in the ECB, it's more of like, yeah, the market overreacting, but the flows, taking expectations into a zone where we may say that they are actually a little bit overdone. So because I don't think that ECB is going to cut 0.5% or something in Q1 or half one, perhaps half one, end of half one is a different story. But It's all like this pendulum that swings very far, and now we are probably at some point in that swing where we need to see the next set of data, which is coming in handy because we are having a heavy week of US data going into the FOMC next week. But now it's again over to the US data, right? We had the Europeans. We know that the central bankers are changing tack. We have it now, and now we will have to wait. And this is going to depend. Well, sorry, and this 108 is going to depend on what the US data are doing now, I reckon, in the euro dollar. If we see weakness creeping in, and this afternoon we might already have a very good indication, you know, on this ISM services coming out, and I'm especially looking at that employment George, which was hanging just above the 50 level the last time. If that dives below, I reckon that's going to put a bit of pressure on the dollar again, and we may then see this 108 as becoming a relatively good support. If in turn the US data hold up, then I reckon we have a chance in the euro dollar to go and have a look at the mid to lower end of the 107s. But again, it is my opinion that in at least the shorter term of things, that level should somewhere hold as well, and then we reassess, you know. Then we reassess. And in the meantime, yeah, look at the 108. This is clearly where shorts want to take a bit of profit. Yeah, that's it really. If you start to move back above 60, 65 there, 108, 60, 65, there's this real possibility, I reckon, of a run back to or somewhere into the low 109s. If the US data start to show or continue to show weakness, real weakness.
Yeah. I think it's important for traders to identify what they're trading at any given time. This morning, we're trading what the ECB might do. We're trading the Eurozone data. This afternoon, when the Yanks come in, we won't be trading that. We'll be trading the US data. So, yeah, it might be holding 108 because, you know, a lot of this move from 110 is a bit of a reprice on the ECB and the data being a bit soft, blah, blah, blah. But that doesn't mean that that's going to bottom out on those factors, or it means it could bottom out on those factors from the ECB, but it might not bottom out on the factors from the US. You know, strong data, then the market's going to scale down, cut expectations for the Fed, and that's going to be positive for the dollar. So that's when you get your move through 108. So you can't sit here and go, yeah, 108 is good for the ECB. It might not be good for the Fed. So just know each session is important now for what exactly we're trading in each pair, because obviously there's two sides to a pair. We've been trading the euro side today. Later on, we'll be trading the US side of things. So don't get married to a bias or a set or a position based on one or the other, because you've got to know what one's going to be trading at any one time.
And if you have some advance or leeway or so, if you're into a decent position already, don't be scared to put a trading stop or so and just take what there is as pips and then reassess. You know, this is the kind of seen that when we were doing the low in the euro dollar, the US numbers were already starting to turn a little bit, but then we had a catch up of the European data, and then actually euro dollar did its low a bit after the US data was starting to turn, and then we were moving up. And here we are seeing the same. We were doing the top in the euro dollar where the EU data were already turning as well, and now we are coming back. You know, the pendulum swings. I guess around this 107.5 or so, 107.5, 108 zone. We're about in the middle, and really need to reassess. But if the US numbers are bad, don't get married to the position, as Ryan says. I'm not going. Won't be anyway. That's for sure.
Exactly. And if the data is good and we still can't break 108, then technically you have your level. And it says, you know, even a good bit of data, we're not getting through the 108 level. So, you know, always lots to consider. But, you know, you take each session as it comes. You can't say, well, this is going to be in 2 days' time, worry about what it's going to be in the next 20 minutes or the next hour or so. There was a final bit of data just to mention, nothing huge. It was US factory orders yesterday, came in softer than expected. Durable goods was revised to unchanged. So that's the factory order. So looking far softer than expected. These expectations are a bit volatile. Another calendar ad was minus 3%. Came in minus 3.6, so worse all round anyway. So again, excuse me, bit of weaker data from there, but as mentioned, the durable goods revision was unchanged at minus 5.4%. OPEC, Saudi energy minister has said that OPEC plus cuts can absolutely go beyond Q1. So just trying to keep prices propped. Those of you who follow oil would have noted that since the OPEC stuff, oil was falling out of bed. I've had this 78, 79 area. I've got 79 on the line on the chart there. We're still largely holding below it. It's not getting above and holding it. So it's keeping the bearish bias in play, at least from the OPEC stuff. I want to see it busting down a few more lows. It could be that we've just traded out OPEC now, and we might see a bit of sideways action. If we do hold below 79s, then we should put in a test of this prior low around the 76.60s, bust that, then we might go and have a look at down here. As you know from the last shows, the US Department of Energy said they're going to lap up oil while the prices are dropping, so they're getting ready to put in their bids. Biden's ready to get his open up his trading platform and get his bids in to fill up the SPR. Let's hope they make a better go of it than the hash they did last time, when they could have been buying it down here and decided they were going to start buying it. We're talking about US oil, of course. They could have been buying it down here, and they started to decide to buy it up here somewhere. So who knows what those guys want to do. Maybe they need to come and watch the flow show for a bit to learn how to buy at the bottom and sell at the top. Anyway, that's it from the headline front. Unless Kay's got anything of note.
No, not really. Just a couple of opinion pieces we've put in the news and research room in our chat rooms. For the rest, no, not really. No. Looks as if though the German companies are still not very optimistic. Yeah, there was an article out yesterday about that, about the cutting their investment plans and thinking the economic gloom is deepening. So it's still a bit of risk in Germany, I reckon.
Yeah, we've still got this budget mess overhanging things as well. The government coalition still trying to agree on what to do with all this budget stuff. So that's another bit of a drag for the Germans, but that's their ball to play with. Right, it's just looking at a few prices. Aussie dollar has taken a bit of a spanking after the RBA. I know a few folks in our room short on this one from up above. Nice trading from those guys. Seems a bit of a overreaction. I don't know. I wouldn't say overreaction. I'm surprised to see such a reaction to the RBA in this one. But maybe again, we're just seeing a little bit of dollar strength weighing across this as well. So maybe a bit of a double wind for the US dollar side of things anyway. But it's put us down towards these lows here, down that prior low that we're pretty much holding around 65.70. We got a bit of traffic through here, 65, 50, 60, 70s, wherever you want to draw your line. We've got under, again, this bit of an intermediate line around 65.80s. We've broken that. We're holding below that. So we've got a little bit of ping pong going on at the moment. So if you're trading this one, if you've been short up here, nice, but be careful that we're just not moving lower just yet. I think if you get back above here, then maybe we put in a test of 66, see what it wants to do there. If it holds there, it'll keep the downtrend in play. Conversely, test and get through here, then we're going to continue on down, probably maybe have a look at this fair size zone further down in the low 65s, that old 65-20 area. That was quite a significant level on the way up, as you can see there. So that's going to be a pretty big zone to look at. A lot of people still I know Dale's a bit bullish, the Aussie, but he wants better levels. He might be getting it. We'll have to ask him on F.A.C.E later what he's going to do with that one. Euro sterling, bit of tug of war again between what's going on in cable and euro dollar. So we haven't retested down towards this 85.50 area again after that first test. Let me zoom it out a little bit. Let's go into that one. I can now get rid of that fib because it's all busted and done. So yeah, we haven't had another look at that 50 level. So again, we might be peak pricing for now if you get my drift over what we were over the bullishness we've seen in the pound for the last couple of weeks. The pound outperforming the euro and a few other pairs at the moment, but a bit of a pause going on here for now. Really, the marker is the 85.50 and back up to 86, 86.10, that sort of area up there. So this pair, once it's had a move, it can do a lot of sideways for a while, but that's going to be certainly my markers to see whether we're going to be heading lower or moving back up again on that one. I've been really not doing an awful lot at the moment by managing what I've got. I'll have a quick look at dollar China, although that's not doing an awful lot again. Still moving between the zones. Haven't had the breakdown I was looking for. 711s, 712s, this area here, this zone here, but neither are we breaking back above 716, 717. So back to showing my fingers on the table for this one to see which way it goes. But that easing story, not doing an awful lot for this one. The market happily placed on this, and we know that officials are keeping a lid on this one, creeping back up as well. Kay, do you want to grab it for a couple?
Yeah, it's going to be a quick look today. Like we should be
while I'm
looking at a few dollar pairs, perhaps.
While I'm switching over, I just wanted to go back and answer Richard's question, asking about the net short versus net long positioning on DAX market. Are you talking about retail positioning? What positioning are you talking about? If you're talking about retail positioning, you've got to know that there's not enough size in retail positioning to push the market anyway. And if it is retail positioning you're looking at, that 80-20 marker pretty much reflects why 80% of people in the market lose money in the retail industry, as you can see from the broker stats that they're forced to show these days. But yeah, let us know what positioning you're talking about. Is it more institutional or is it just the retail numbers? And I'll answer that after Kay's done and dusted.
Yeah, okay. Just to show you what the Schnabel effect this morning dragged the differentials on the in the short euro versus the dollar a bit lower, and that's your I guess we can say now this is your 108. In if we hold, so we are around 200 BPs. Huh? We are if we hold around there and move deeper south, that would mean that the US data are outperforming those in the Eurozone right now. And then if we move down into this zone, this is probably where we are going to see this 107, those low 107s come in and play up. It's not an exact science. It doesn't overlap all the time with the euro dollar, but when you see those moves higher, that was when your euro dollar was on the move up, and now this is your correction clearly. So keep an eye on what's happening in those differentials this afternoon, because it could be a driver, especially for the euro dollar. Yeah, so this euro, the 108 showing up, as Ryan already mentioned, this is the area, and then this is where, if the US data do better, really, I'm looking for this zone here to to start stabilizing this whole move. We had this acceleration, undo most of the acceleration if the US data are holding up better, that is, because if they don't, then I think there is a bit of a risk that we get back above this 60, 65 zone here and have a look back into what's happening in the 109s. The market is in a reaction function right now to a lot of the data. You get inflation on the one hand, but as I said earlier, I do think that in the case of the US, we have to look. We have the headline numbers, and then we may have like a double whammy or a saloon door here this afternoon when you look at the ISM employment coming out together with the JOLTS job openings, right? So we are at the start of this week's real moves in the dollar, possibly. Okay, so we are stabilizing in the cable. We're stabilizing around this 126.40 zone. That's a bit your neutral, I would say, right now. And look what happened here. A bit in line with what happened on the euro dollar, right? You're getting support here around 126, figure 5, figure 10. That is going to be an area to watch. Okay, if cable drops below 126, then we're probably going to have a look at 125.5 again. But again, it's really going to depend on the US data. Knowing that, and we were talking about that in our room as well, we are stabilizing on the euro sterling. Yes, it held 85.50, but to say that the sterling is turning around the corner, we could also say that you have to get back above 86, figure 10, figure 15. Ideally, we should have a test here to see the strength of the sterling. This is going to be a very good barometer, I reckon, for the sterling, because euro is a little bit weaker, so the sterling is still doing a bit better. But if you start to get a test and a break above this 86 figure 15, then I reckon the party for the sterling may be over as well, because in the current context of what we see in the data and a little bit of divergence in the data, it should actually cap. And then the sterling can still continue to outperform. Ideally, I'd like to see a test of this 86 figure 15 to make up my mind in euro sterling. And I also think that unless really European data are really collapsing and doing really, really bad, I would say though that this 84.80 figure is still going to be a pretty decent zone that we need to take care of. If it gets down there, I wouldn't be wanting to sell in the hole. Let's put it that way. Perhaps that the strength in the sterling may have ran its course. Dollar yen, because this is probably going to move over the upcoming US data. Yeah. We're still turning around this channel trend line. We have broken below a couple of times, right? But we need to note as well that we are holding around this 38.2, which is in the 146.30s. I've seen other people calling for 146.10ish to be a level as well. This is going to be important this week, because if it starts to break, that really means that the US data are starting to do worse, okay? So keep a very close eye on what's happening in this 146.30-ish zone. On the top side, this trend line here, this little trend line coming from the highs, it used to be a parallel, so but it's not really. But anyway, this little trend line here, if you look at it, it comes in at around 148 right now. This is where your 4-hour cloud and your daily cloud bottoms are as well. So if you get better numbers out of the US, keep a very close eye on what's happening around 148, okay? Because that's, I think, now your new resistance. One could argue it's around 148.5 or even around, up in the 148.80s, but I think the 148 is already going to be a good enough barometer for the dollar yen weakness or strength. And as we were saying, the market did not really react too much on the Japanese CPI. So it's really over to the dollar. and perhaps the euro, to decide whether the yen is going to strengthen or not. Have a quick look at where we stopped on the euro yen. Those prior tops here in the 140, in the 158.60 zone is our low today, and not far from our low yesterday as well. So 158.60 above or below may already be enough to decide on the future direction. If it goes through it, I reckon there's another 1% waiting here down to 157, the figure. If that level gets retested and holds, why not see a move back up into the 160s, mid 160s perhaps. But I found it interesting that this morning this one held on the 158.60 level. Okay. Yeah, the Aussie Ryan was talking about. So we rejected it, and we are now back around this 200 DMA, which is waiting here. I do think the surprise of it having reacted so much to the RBA, yes and no, because I think it's a fact that we kept here, and then I think also a bit of repricing of those of the Aussie crosses. You know, Euro Aussie was quite weak. People were trying to buy Aussie Kiwi in this 108, 107, sorry, 10, 20, 25 zone, and that's gone through now. I think it also has to do with stop losses on some of the Aussie crosses, because if you go back to the Euro Aussie, look at it was really trying to break on Friday. We had a bit of a reversal already, but it was still hanging pretty low yesterday, and even this morning before the RBA, ready perhaps to take another dive, but the market needs to reassess, and we are now already back above 164.5, which was a bit of a zone here. Okay, so all of that was weighing on the Aussie dollar, and I guess now it's back to the US, and see where we close above or below this 200 DMA, which is also the 50% of this move around this move here. Okay, this for the Aussie dollar. Kiwi, I don't have much to say, although we went pretty close to that trend line yesterday. We went very close to it, just below or around 62.25, and rejected. So that's going to be a big level still on the top side. I spoke about that last week. We had a visit and it rejected. Okay, for now. So this is your top side level on the Kiwi, and we're back to more neutrality here around 61.5. Okay. I think that's about it. Ryan, just quickly, I'm still looking for this one here. It's still bid and stabilizing at too high levels for me. But if I get a bit of a weaker set of US data, I'm going to look at what's the reaction be. 1857, 1860, stretch it down to perhaps 1852, 53 on the dollar rand. If it holds, that means that this pair is still pretty much poised to go up. And talking about the rand, was it the GDP this morning came out weaker again than expected? Okay, minus 0.7 in Q3, negative on the year-on-year, negative on the quarter-on-quarter. So the problems in South African rand are not over yet either. And with that, Ryan, I give it back to you.
Thank you very much, sir. Right, just to answer Richard's question. Yeah, so that's the stuff on the daily FX. That's to do with retail, and it's you say it's from the IG client sentiment. So that's not going to have any sort of impact on why a market will move. Really, even the CFTC COT stuff doesn't have an impact on the moves. It may do more so for futures on equity markets than it does for FX. I've put the link in there, Richard, to the CFTC, so you can go through the various exchanges and find the relevant info. Obviously, you're not going to get DAX on there because it's German. I don't think the Americans have a DAX futures market over there where you'll see that. Yeah, so oh, okay, you're back on. Okay, you're back on.
Oh yeah. While the screen was black, I was just showing.
Oh, sorry, mate. Yeah. Sorry, I've got to take it back. So yeah, the COP report was all the US. So you get the S&P. Oh, the link is just above that comment where you cannot see the. You cannot see the.
Ryan, you sent it to host and panelists. You have to send it to everyone.
Oh, why has that gone to there?
Yeah.
Bloody hell! Right, hang on. Let's do that again then. There we go. Try that one to everyone. Can you see that? Okay. Yeah. Yeah, again, this is bar chart. You can look at the COT stuff. But yeah, the CFTC stuff, you've got to remember there's what's called non-financials, which they class as speculative. So that's one side of the market. In the other reports, you'll get the institutions, the asset managers, the fund managers showing their positions. So it's all right knowing where the supposed speculators are positioned, but you also need to know where the others positioned, the financials are positioned as well. And then you've got to remember that this stuff is delayed by, it comes out on a Friday from the prior Tuesday's positions. So things could have changed since then. And also it's not, in futures, it's obviously a reflection of the market, but for things like FX, it doesn't have that strong a correlation between what's happening in the spot markets. You know, spot markets are hugely bigger than what's going on in the futures market. So it gives you an idea of which way people are leaning. I wouldn't use it for trading per se. I've seen people well offside in these futures reports. I've seen them up, particularly like dollar yen some time ago. They were offside hundreds of pips for almost 2 years. Because remember, futures can be hedges against options and strategies and spreads and all sorts of plays going on. Anyway, you'll have all your information there. You might need to do a bit of searching around that site to find exactly what you want. There's enough there to look at. Anyway, that's that. On that note, be mindful of the data coming up later today and the impacts it's going to have on the dollar. And we shall see what that data does, and we shall chat about it tomorrow. Have a great day all. Thank you very much, K-Man, for all your stuff, and